Right, so this is going to be the main material we are going to cover for the final, okay? So as you can see, so there are a couple of chapters. So this is one chapter. This is the second chapter. This is the third, fourth, and the fifth. Actually, so depending on the textbooks, you should usually these combined in one chapter, right? So and then from here you can see this is kind of I call the semi-accumulative, right? In the sense we only cover actually this coming from the module 2, and this coming from module 3, and this last 2 coming from module 4, right? Just remind you what we have learned in this class. Okay, so in module 1 is a review of micro. Okay, so we are not going to test them again because this is a macro class. First of all, okay? We start with from the module 2. So in module 2, what do we learn? We learn how to measure in our macro economy. So we study how to learn GDP, price, unemployment, and economic growth. And then in module 3, so what do we learn? That's built upon module 2. And then module 3, so we study how we make sense of the numbers we have come up from the measurement in module 2, right? And then we studied a few models, particularly you study income expenditure model and aggregate demand, aggregate supply model. And also in module 3, so we learned what causes the fluctuation in our economy, like including GDP and unemployment rate, right? And we also learned, so we primarily focus on demand shock, right? So that's what we learned in module 3. And then in module 4, that's a module we just finished. So we study fiscal and monetary policy, right? So that's built upon module 3, because module 3, first we see there, or we understand what causes the fluctuation of our economy. And from those discussion, we understand there's a room for improvement. There is a room for government intervention. And then in the last module, what we learn is, so we just look at how the government can intervene through different policy. That includes fiscal policy and monetary policy. All right. So that's the big roadmap, what we have learned throughout this semester. So you can see this just built upon step by step, right? So now let's see, so what do we have learned in GDP and the price level, okay? So we define what is GDP, and then we use a circular flow diagram, right? And in this diagram, there are a bunch of concepts you need to pay attention. Government transfer, government purchase, inventory, investment spending, right? And we also look at financial assets, import, export, value added, intermediate goods. So based on this circular flow diagram, so we learn there are 3 approaches to calculate GDP, and they all should come up with the same number. So this includes income approach, expenditure approach, or product approach. The logic is pretty simple. 1 penny I spend must become somebody else's income. So everything we produce, it then must exhaust as a return to the factor, to the owner of the factor. But what are the factor? Factor are those things used as input to produce our goods. So that's why these 3 approach, they must give you the same number. And toward the end of that chapter, we studied nominal versus real GDP, right? And so you make sure you understand, so why we want to differentiate between nominal and real. So sometimes, so depending on how you calculate the GDP growth rate, so you're going to get a different growth rate. So hence we use Chen dollar. Make sure you review what is Chen dollar. And then there, so we look at a base year, price level, okay? And later we look at price indexes. So that's going to be depending on the market basket you define. And then we look at CPI, PPI, GDP deflator. Make sure you understand, so their relationship and what that means. Okay, so this is the first chapter that's going to cover in the final. Now the other chapter, is a macro relationship and aggregate expenditure model, right? Essentially, so we started with MPC. Oh, by the way, so essentially, this is an income expenditure model. So basically, we are going to see Y equal to C plus I. And the Y here, so this is expenditure. And around the right-hand side, C is going to be function of Y. The Y is going to be function of Y. And on the right-hand side, the Y is income. So that's where the name income expenditure model comes from. But remember in GDP, so in the chapter about GDP, we knew, so these three approach give you the same number. So then income equal expenditure. So that's how we end up with this equality. From this equality, we get one unknown or one variable. So that's going to determine in equilibrium. This is why, right? Okay, so we started with MPC, which is marginal propensity to consume, and the MPS, which is marginal propensity to save. And we studied the multiplier, right? And then, so we look at aggregate consumption function, investment spending, right? So essentially, so those are the aggregate consumption and investment, how that adjusts with income. Okay, and in terms of investment spending, so make sure you understand the inventory investment and the adjustment in inventory. Like remember the example I gave to you, think about the local car dealership, right? So if there's the weak demand, what happens to the inventory investment? If there's strong demand, stronger than expected, and then what happened to inventory investment adjustment, right? And then, so we have this aggregate expenditure model, right? So this essentially the income expenditure model, and we have a Keynesian cross. So actually this refers to this equation, right? And also make sure you understand what causes shift of the planned aggregate expenditure line, right? Furthermore, so there's another multiplier, right? So that's the second chapter, okay? So that corresponds to module 3. Now go to the last module that we just finished. Right? So we focus on government policy. We start with fiscal policy, right? So make sure you understand what is fiscal policy, right? So when we talk about fiscal policy, we mention or explain government transfer, social insurance program, right? And then, so we differentiate, we characterize fiscal policy by expansionary versus contractionary. So make sure you understand what are they, right? And then, so we talk about some critiques on expansionary fiscal policy. So basically it just says, so the expansionary fiscal policy, when we have a recession, can be limited. So those are the critiques. Make sure you understand what those critiques means and what the answers to those critiques. And then, so we have a lag in fiscal policy implementation. Okay. And the next, we look at multiplier effect of government spending versus transfer, right? Remember that we have examples. So the government has, for example, $10 billion to spend. The approach 1, so the government initiates spending immediately. Approach 2, the government gives the households some transfer. Then households decide how to spend. And then, so from the example, we see, so eventual impact on the economy is quite different. And then, so we also talk about discretionary fiscal policy versus automatic stabilizer, right? Just make sure you understand, so what are they? And if I give you an example, so you can identify what type of policy they are, okay? And then in the last part of this chapter, we talk about the government budget balance. We study deficit versus public debt. And we also talk about implicit liability for the government. Okay, think about aging population, rising healthcare in the United States, right? So now we go to the last chapter. So money and then monetary policy, right? So in this chapter, we start with money. Okay, make sure you understand what's defined as money and the 3 functions of money, right? And then we talk about a few concepts. This including currency in circulation, checkable bank deposit, demand deposit, right? So those are useful for us to understand the money supply, right? And when we expand this concept, we learn this concept, we also expand the liquidity, right? Or so liquidity probably is probably not the right word. How liquid is the assets? So that's what we talk about, right? So, for example, currency is very liquid, right? Your home has value; it is a financial asset, but it's not liquid. Okay, so remember, just look at those examples. And then next, we look at the history of money. So in human history, we start with commodity money, and then we evolve to use commodity-backed money, and finally we use fiat money. Okay, make sure you understand the difference, right? So we talk about money supply. Okay, regarding to money supply in class, we explain M1 versus M2. So make sure you understand what is included in M1 and what are included in M2. And then we talk about how the banks can create money, right? Remember, so M1, so less than 50%, less than half are currency. And then the rest of the majority is a bank deposit, right? So this is called M1. That's the most liquid form of money. And from the M1, you can see, so the money largely, or the big chunk of money supply was created by the financial institution, particular banks, right? And then here, so we explain how bank creates money. And there, so we talk about reserve requirement, monetary base, and a money multiplier, right? And then lastly, so we talk about the potential risk in banking system. This is called bank run. So that's why there are bank regulations. We talk about a bunch of bank regulations. So this includes FDIC insurance. This includes reserve ratio. This includes discount window. And this includes the capital requirement for the bank, right? Okay, lastly, we talk about open market operations. So this is how Fed, which is Federal Reserve Bank, how Fed can change monetary base, eventually affect money supply, and eventually affect aggregate demand. Right. So that's a quick review of what we have covered, right? So now let's go to the sample test, right? So there are a bunch of questions. Okay, so from the questions, that's going to give you a sense what's going to be covered in the final exam, right? So starting with the first one, real GDP measures. Okay, so that's pretty straightforward, right? So that's coming from module 2. Okay, so the answer is C. Value of total product linked to price of a single year. Okay, so there are two things. Number one, this is total production. Okay, and then number two, so think about the price. Okay, because this is not nominal GDP. If it's nominal GDP, then the value of the total productions at the current price. But here, so you need to, so we emphasize, so this is a price linked to a particular year, right, to avoid the price change. Number two, which of the following is not a component of income approach to GDP? Okay. So the answer is D, right? Net export is not income. So wage and salary, that's income to labor. Corporate profit, that's just a profit. Proprietor income, so usually that's the income for capital. Okay, so D. Now, 3, potential GDP is, the answer is C, the maximum amount of GDP that can be produced while avoiding shortage of labor, capital, land, entrepreneurship that will bring rising inflation. Okay. And so the potential GDP essentially is what the economy can produce in the long run. Right. So you may want to review this with the chapter on aggregate demand and aggregate supply. Right. And other things I want to emphasize is, so when we producing at our potential GDP, the unemployment rate usually is greater than 0, and the unemployment rate equal to the natural rate of unemployment. Okay, this is 3. 4, as disposable income increase, there is, so this asks you consumption function, right? And so usually, so this is going to move along the curve, because remember consumption function, so you have, this is just show you the relationship between consumption, aggregate consumption, and the income. So now this asks you the disposable income increase, nothing else. So you see that's one of the variables. This is C. Now question 5. One reason aggregate expenditure curve slope upward is because the answer is C. Aggregate expenditure curve that essentially equals C plus I. C function is increasing with expenditure, increasing with income, right? So that's why the aggregate expenditure curve slope upward. So largely coming from C. And remember in class, in the example, usually we say I is fixed. By the way, this is planned investment. Okay. Now, question number 6. Equilibrium expenditure is defined as level of aggregate expenditure. Well, the answer is B, aggregate planned expenditure equal to real GDP, right? Okay, so they just coming from here. Okay, so C plus I equal to Y. And this I is planned. And the left-hand side is the AE planned. Right-hand side is real GDP. Okay, so remember in class we talk about the adjustment process. If real GDP is too high, and then leaves the planned aggregate expenditure is smaller. So then you're going to have I unplanned will increase. So that's a signal. So we have been too optimistic, and usually that's going to reduce the production until we reach the point AE plan equal to GDP. Okay. 7. In general, the flatter aggregate expenditure curve. Okay. So the answer is B. Why is that? The aggregate expenditure curve, the slope comes from the aggregate production function, aggregate consumption function. But this over here. But what determines the slope of consumption function? MPC. Flatter, meaning the MPC is smaller. If smaller MPC, that implies a multiplier which equal to 1 over 1 minus MPC. So that's going to be smaller. Right, so this is multiplier. Okay, so this is 7. Now we go to the second page. So question 8. If the federal government tax revenue are greater than its outlay, then the federal budget has, so this is a chapter, this is about fiscal policy, right? So usually it means the government has a surplus. So tax revenue is the government's income. Outlay is their spending. Income greater than spending, meaning they have a surplus. And usually if the surplus, that's going to help to reduce government debt. Right. Question number 9. According to Laffer curve, raising the tax rate, the answer is D. Okay. I apologize, we did not cover this concept in class, but I can briefly explain to you what this means. The Laffer curve just show you the relationship between tax rate, tax revenue. Okay. The curve usually looks like this. And why is that? So this is because tax revenue equal to tax rate times taxable income. Okay, so when tax rate increase, so usually that's going to reduce taxable income. Why? Because that's going to reduce your incentive to work, reduce your incentive to invest. Okay? And then what's going to be the net impact on tax revenue? So because one is increased, the other is decreased, then they are multiply each other. So usually mathematically, so this is how it is. This is Laffer curve. All right. Number 10, increase in income tax rate, employment potential GDP. Okay. The answer is B. Higher tax rate, reduce employment, and then reduce potential GDP, because tax usually will distort or will reduce your incentive to work, to invest. Okay. Now, 11, monetary policy is controlled by, answer is B, Federal Reserve, or in general controlled by central bank. Okay, and the central bank is independent. All right. 12, the Fed's goal includes, their goal includes price stability. Right, so remember, so we talked about there are two goals of Fed. One is price stability. The other is labor market, right? Okay, so monetary-based stability, that's not their goal. Okay, so but they can control or affect monetary base. Open market operation, that is their tools to achieve their goal in terms of adjusting money supply. Maintaining a low federal fund rate, that's also not their goal, but they can adjust federal fund rate to achieve their goal. 13, federal fund rate is the interest rate. The answer is A. Bank charge each other on overnight loans. Okay. And here I want to emphasize C. The Fed charges commercial bank on loans, so that's called discount rate. Okay. 14. Gross investment equal net investment plus, the answer is C, depreciation. So what is depreciation? So that is the machines or buildings that start to worn out over time. Okay. Now go to the next page. Okay, we kind of reverse. Now we go to earlier questions, early chapter. In the above figure, so this is a circular flow diagram for us to understand how to calculate GDP. Consumption expenditure is shown by, so that's straightforward, right? So consumption expenditure, so that's in goods market. So that's households purchase goods from the firm. That should be B. All right. 16. All of the following are included in gross private domestic investment except 16 answer is C. Business purchase of another company's stock. So that's not investment spending. Right. So now we can look at A, B, and C. So those A, B, and D, that's a good examples of investment. Retail stores purchase of shoes to add to its inventory. So this is called inventory investment. Household purchase of new house. So this durable goods, and this is also called investment. Business purchase of fleet of car. So that's another good example of investment. Okay. 17. Goods that are produced this year, stored in inventory, and then sold to consumer next year. The answer is B, right? Or you should realize, so this cannot count as next year's GDP, right? So it should count as current year or the year the good was produced. 18. Which of the following is not phase or turning point of the business cycle? The answer is B, right? So by the way, let's just review the business cycle. Okay, so the business cycle, so we have issue like this, right? And this is a peak, this is trough. Okay, and then so here we are in, here we enter the recession, here we start in expansion, right? So 19. So what is refers to period when decrease? Okay, so the answer is B. Productivity growth slowdown refers to a period when growth rate of output per person decrease. Right? So you can compare this with A. Right? Because productivity is measured as output per person. Okay. So let's go to 20. For movement along the short-run aggregate supply curve. A, potential GDP remains constant. Yes, this is true. B, the real wage changes. Actually, yes. Right? And C, the monetary wage is constant. That's also correct. Okay, so answer is D. Okay. So here you may want to review what caused the short-run aggregate supply curve a upward slope. Higher price leads to higher real GDP or GDP or higher aggregate supply. 21. The long-run aggregate supply curve is vertical. Right? Now here you need to review what determines the position of long-run aggregate supply curve. So actually that determined by technology. Your capital stock, your labor. And then remember, so in earlier exams, so we have examples. Okay, so for example, so there's a immigration law reform that's going to increase the labor force. So usually, so that's going to lead to a higher level of long-run agri supply. Okay, now we go to next page, 22. A rise in the price level change aggregate demand. Okay, why is that? So the answer is C. So actually, so the aggregate demand curve is a downward slope. Higher price, lower aggregate demand. And then we say there are two reasons. One is the income effect. The other is interest rate effect. So the income effect actually refers to here because the higher price is going to reduce your purchasing power. So your aggregate demand will decrease. 23. As the price level fall and other things remain same, real wealth will increase, right? Because your real wealth is going to invert, sorry, so a lower price is going to, apologize, yes, so real wealth will increase because your purchasing power will increase, right? And then the quantity of real GDP demanded will increase. So that's because the income effect. Okay, so answer is C. Now we move to next one, 24. So we have this table. And then, so this table asks you the government revenue. So government revenue coming from where? Usually coming from tax. Right? So now let's see, so where are their tax? This is their tax, this is their tax, this is their tax, and tax. Right? And then so we can add them together. So the answer is D. And here, so you can also calculate the government outlay. So that includes here, here, and here. So those what they need to spend. And finally, by comparing the revenue versus outlay, you can find out whether the government is running a surplus or running a deficit. Okay. Now, 25. This question asks you what is considered as government outlays. Okay. So the answer is B. Purchase of corporate bond. That's not a government outlay or not a government spending. Right, so actually that's government investment. Okay. 26. If a tax increase people's labor supply, then the answer is A. So that's going to increase potential GDP, right? Because potential GDP is going to rely on, as I just explained to you, technology, capital, labor supply. 27. The supply side effect of a cut-in tax rate includes how would that affect labor supply? How would that affect the supply of loan fund? So these just follow question 26. Cut tax usually increase labor supply, right? And then, so how would that affect loanable fund? But remember, this coming from saving, right? Because the loanable fund essentially is coming from household saving. But where the household saving coming from their income. Now the tax cut increase the labor supply. Usually that's going to increase their income. And furthermore, the tax cut is going to increase households' disposable income because they pay less tax, even at the same level of labor supply. So answer is C. This is 27. 28. Suppose that the government increase tax. One effect of this change is that it decreases. So increase tax, okay, usually, so that is going to cause a decrease in disposable income, right? Because households need to pay more tax, right? And then if the disposable income decrease, that's going to decrease consumption expenditure and aggregate demand. Because remember, in the income expenditure model, when we talk about aggregate demand, or when we talk about the consumption function, so consumption is a function of disposable income. Because in the early chapter, we simplified the model, says, okay, so there's no tax, no government. So disposable income equal to real GDP. But actually, so disposable income is what is your income minus tax plus transfer, right? So here, so increased tax, that's going to reduce your disposable income. Okay, this is 28. Now then move to the next page. A physical action that's triggered by the state of the economy. What this means? It just says, so there's a government fiscal policy that will automatically put in place when the economy changes. So for example, if there's a recession, and then the unemployment insurance benefit will be more widely available to the population. And then so here, so the answer is obvious, called B. Right? So this is called automatic physical policy or automatic stabilizer. So here, so you may want to review what is a discretionary physical policy. So that's usually like one time, okay, after some deliberation. Right? So this is depending on the discussion of the Congress or the president, right? So now move to the next one, 30. Which of the following bodies are responsible for the conduct of monetary policy? Okay, so that's pretty simple. Federal Reserve Bank, okay? Or in other words, central bank. So this is for the US, right? So remember, so for Great Britain, it's called Bank of England. And Japan is called Bank of Japan. And in the Europe, so they have a supranational central bank, it's called ECB. Okay, but if you remember this, that's good enough. Now, 31, which of the following doesn't describe a function of money? Okay. So the answer is B. It is a unit account, store of value, and a median exchange. Right? So it doesn't hedge against the inflation. As a matter of fact, so money is going to expose you to inflation. Right? 32. The function of money are, so that's just repetition, okay, B. Oh, by the way, here, so we have M1 and M2, make sure you remember, or you can tell which financial asset is characterized as M1 and which is characterized as M2. Let's just quickly review. M1 largely includes currency in circulation, plus your deposit, checkable deposit in the bank. This is M1 largely. And then M2, so include M1 plus your saving account. Okay. 33, barter. So what is barter? So we talk about that briefly. So when we talk about money, barter, so essentially is we exchange goods for another goods. So that's before we adopt money, all right? So the answer is D. $34, money. The answer is A, is any asset, any commodity that's generally accepted as mean of payment. Okay, so here we got commodity, but you can replace this with assets. Now 35, US currency. Okay. So the answer is C, is composed of the bills and the coins held by individuals and business. So US, the other way to see the US currency is US currency is part of M1. All right. Now 36. In the US today, money consists of, the answer is B. So here money, so actually we refer to M1. Right, so by the way, here, so I just give you the definition, M1, M2. Right. So that's up to now. So we have quickly finished the review. Okay.